The US dollar came under pressure this week as divisions in Congress deepened over the prospects for US tax reform. The US dollar fell against most major currencies this week as US bond yields trended lower over concerns over US tax reform. Over the past week, we have heard proposals from both Republicans in the House and in the Senate, and there are notable differences between the proposals. Republicans in both houses are very keen to deliver on tax reform and will work hard in the coming weeks to try to resolve these differences. But the key problem is that they're walking a very fine line in terms of the impact on the budget. According to Senate rules, in order to pass tax cuts with only 51 votes in the Senate, the Republicans are going to need to limit the deterioration in the budget to $1.5 trillion over 10 years. But if they want bigger tax cuts than that, they're going to need 60 votes, which means they need the Democrats to join them. The main focus in Australia this week, aside from the Melbourne Cup, was the RBA decision 30 minutes before the big race. The RBA kept the cash rate at 1.5%, where it's been since August 2016, as fully expected. In the commentary, it remained quite upbeat on the growth outlook and also the strong job market. But it did concede that inflation was softer than expected, and it expressed some concern over household spending given soft income growth and high debt levels. There was little reaction in the markets to the RBA statement, with interest rate markets pricing only a 25% chance of an RBA rate hike by June 2018. The Reserve Bank of New Zealand also met this week, keeping its cash rate at 1.75%, as was also fully expected. But there was a bounce in the Kiwi as the RBNZ's quarterly projections of the cash rate ticked a little bit higher from mid-2019. The Kiwi outperformed the Aussie on the week, though so far at least the 110 level has not yet been broken. The week ahead in global markets should be quite busy. In the US, along with the tax debate, we will hear from many Fed speakers. At the moment, markets are quite confident about a Fed rate hike in December, pricing at around a 90% chance. But they're very divided over 2018, split between pricing 1 or 2 rate hikes next year, in contrast to many Fed officials who are suggesting 3 hikes. Australia's busy data calendar in the week ahead includes October business confidence from NAB, November consumer sentiment from Westpac and Melbourne Institute, third quarter wages data, and on Thursday, the October employment report. Job creation in Australia has been very rapid in recent months, so there's always the risk of a statistical correction. But with indicators such as job advertisements and business surveys still indicating ongoing job creation, Westpac is looking for another good month, a rise of 20,000 in October in total employment, and the unemployment rate holding steady at 5.5%. If Australia's job report is as solid as we expect, then the Aussie should continue to avoid a break of the 76-cent level. But rallies are likely to peter out around 77.50 in the week ahead, so long as the range of Fed officials on the wires remain upbeat on the US economy. We'll speak to you next week.